Hey everyone, so this company doesn't need much of an introduction. We all know we shouldn't be betting against Elon Musk. So the question is, should we invest with Elon Musk in Tesla and be part of this story? Is the story just getting started or has it already kind of run its course? So let's jump in and figure out the fair value of Tesla shares. Okay, so figuring out the growth rates for Tesla are a little bit tricky. So what I'm going to do first is I'm going to put the revenue here into a compounding growth rate calculator. It's telling me for the last 5 years it's grown at 47%. If I look at for me, I'm looking at Q2 2023. Whenever you're watching this, just go into the quarterly update and have a look at, looks like it's slide 4. It gives you the year-on-year growth rates. So we can look at total revenues is up 47% for the year-on-year. But if I look at some other numbers like net income and earnings per share, they're up 20%. Free cash flow, as you can have a look, is quite lumpy. It goes from 600 million to 3.2 billion, down to 1, down to 0.4, back up to 1 billion. So that 62% free cash flow growth is a bit deceiving. Yeah, I would look at this net cash provided by operating activities and sort of average out these numbers. It looks like it's about 13 or so, 13 billion roughly on a 12-month basis. So that's going to be helpful when we have a look at growth rates. But having a feel here, this is where a lot of the assumptions, so you've got to understand the business, you've got to think about Elon Musk and what their plans are for the future. And the more you study this business, the more comfortable and confident you can be on the growth rates. Now, I've done quite a bit of work on this and I've got my best feeling at the moment, which will change over time. I'll probably be updating this quite regularly, especially for Tesla, is that I'm looking at growth rates of around about 25% for the next 5 years. I think that's quite optimistic. I think the law of large numbers will catch them. And I think that's more likely over the decade. I think their big growth days are like the 40, 50, 60% ranges. I think you'll get a few surprises here and there with some big numbers, but then you'll get some surprises on the downside as well. And I think it'll average out to somewhere in this. So as you can see, there's a lot of nuance. There's a lot of research that goes into these growth rates. I'm going to be adjusting these growth rates quite often as I study more about the businesses and they come out with new developments and things like that. It's important to make these little adjustments. And I'm going to keep track of these adjustments in a weekly report called Yes Stocks, No Stocks. There's a link in the description for it. You can get it each week. It's free. It isn't some boring newsletter. There's no fluff. There's no BS. I go straight to the valuations and I highly recommend you joining it as I've done a lot of the heavy lifting for you. So I've got a discount rate here of 10%, which is what institutional money is probably looking at. This is sort of how I get a fair value. And the multiple that we're willing to pay after 10 years is a little bit higher than I normally like at 25, just because of the bit of the Elon Musk factor, a bit of those high growth rates, a bit of the potential for what they could be building in lots of different areas, not just in cars. Let's give them a strong multiple. That operating cash minus maintenance capex, this is the free cash flow number. Now, what I did was I went and Googled their maintenance capex. So you just Google Tesla's maintenance capex number, you get to Guru Focus, and it'll tell you on a past 20 quarters or so, I think something like that, an average sort of maintenance capex number. So we get the operating cash flow number minus this 4 billion, and that gives us around about a $10 billion. It's actually about 9 billion, but I've rounded it up to 10 billion just to be optimistic here. Shares outstanding number, now they are diluting at around about 3 or 4% per annum. So I haven't even factored that in here. I've got the total cash and the total debt I've just pulled from the balance sheet. How I did that was I'm just in TIKR. I just go total cash and short-term investments here. It says 23 billion and the long-term debt here of $500 million. So that's where I pulled those numbers from. And it tells me that I want to buy this, but I don't actually want to buy this. This is what I think fair value is of the stock, is $204.15, $205. Let's call it around that. Now, depending on when you're looking at this, for me at the moment, the stock price is 273. So we're above fair valuation according to the DCF model. Now, I don't think the DCF model is perfect. I think we've got to factor some more things in here. So I use what's called a 5-year valuation model. And what I do is I look at the current revenue number. I grow it out over the next 5 years. And then I figure out what I think the mature free cash flow margin for the business will be. At the moment, the free cash flow margins are about 8 to 10%, and I'm saying that they're going to improve to around about 15% in the next 5 years. That is quite optimistic. That is saying that operationally, they're going to improve and quite significantly improve those margins. So yeah, anyway, we're being optimistic. Let's keep going. That price to free cash flow multiple, I'm putting it as 25. Here I've been able to put in the dilution rate, the current shares outstanding number, current market cap, and it tells me in 5 years the target price is about 290, and that will give me a 5-year compound annual growth rate, since the price is about 270 or something at the moment, of 3%. So what I want to figure out is I want to try to get this number to 10%. So what would the market cap have to be? It would have to be around about, looks like about 620 maybe. This is how I sort of figure it out. I just sort of trial and error until I get to 10%. There it is there. So 620, current market cap at 860. That means the share price would have to be down to about $195 a share, and that would give me a 10%. So both the DCF model gave me 205. This 5-year valuation model, even though I have improved the free cash flow margins, I've said that they are going to get better margins. We're still looking at only about 195, so average that out to about $200 a share. Gives us a really good ballpark, I think, for a fair valuation of Tesla stock. Remember that it's got to grow at 25% to just say that, just so you can get your 10% return here. That's pretty intense. That's asking a lot of a company, and yeah, they might be able to do it, but you're not going to get a huge return here. So what I'm going to do now is I'm going to see if I can get what I want as a better return of 22%. What would the market cap have to be? It would have to be around about 380 billion market cap for Tesla. And since the market cap's 860, we're talking about a 60% decline now in the stock price. So a 60%, looks like 65% decline. I can do that roughly in my head. What's that? About closer to $100, about $100 a share. So somewhere around $100 a share is looking interesting. If I look at my DCF model and I want to get my 22% here, it tells me that my buy price is about $85 a share. So somewhere under $100 is starting to get attractive, so you can get your 22%. But remember, like, you want to chase this 22% because the growth rates already have to be quite exceptional just to keep up, really. With the stock price being at 273 and I really want about 100, that's a lot to ask. But strange things happen. Like, look here. Back in what time? This is January 2nd of January 2023, the stock price was $111 a share. That's very close to what I'm looking at about $100 a share. Strange things happen, strange fluctuations happen. So if Tesla is something that you love and you really want to be invested in, you can hopefully be patient and wait for opportunities to come around. It might not be perfect, and you might not get, it's got a long way to go. So that's a bit unfortunate. Now I'm going to keep track of this each week in Yes Stocks, No Stocks, and there's a link for that in the description. I hope you join up for that, because this is where I'm going to share my valuations each week. And as I learn more about the business and those growth rates get adjusted slightly, the fair valuation are going to get adjusted slightly as well. And you can keep track of this. And I've done a lot of the heavy lifting for you. So I hope you join up for that. And I hope you're enjoying the videos that I put out at the moment, and I will see you in the next one.